Hi guys, welcome to my channel. I'm Jonathan Peter from Jonathan Peter channel, and in this video we will talk a lot about mindsets that you need before you get into a trade, whether it is a stock trading, whether it is Forex, and even cryptos. I'm not only explain about mindsets, but I will also give you actionable steps that you can use, you can implement to improve your trading risk mastery, trading risk management, okay? And I will explain it later how important trading management skills for you in order to success in this space. I'm super excited guys, and without further ado, let's get to my computer. Alright, we are already in my computer, and maybe you already noticed that English is not my first tongue. So in order for you to get the best experience from my video, from this lesson, I will use text generator later, okay? Text generator in the presentation. It will be a long video, but I think it will worth it. So from now on, let the text generator take over, okay?
Hi there. Still with me Jonathan Peter from Profit Crafts. So, in this video, I'm gonna squeeze your mind out and give you incredible value that contributes to many traders' success stories you found out there. It is no other than mindset. That is at least what I want to tell you here, and hope you learn and shift your mindset to the right one. Believe me, that is the sole difference between amateur trader and professional trader. The way they think about trading. But of course, I won't give you only mindset with no example on how you apply that in your trading. I won't leave you hanging there. In fact, I will give you rules, so many rules to follow. Even you maybe feel bored with all those rules and can't keep up. But, it is important to respect the rules if you want to be success in this market. Then, I will give you progression templates you will want to use, so that you can plan your trades in a controlled way to get more consistent results. Also, I will tell stories throughout the lessons, so that you can understand it better. Wow, I can feel the heat and excitement here. How about you? Well, I can't wait for it anymore. I will give you all of my knowledge in this long video. So, let the presentation begin. Stop. You are giving away too much money to the market. Why? Let me tell you the reasons. There are two primary reasons why you might just giving away your hard-earned money to the market. Reason number one, trading has inherent risk. And many traders, especially not successful traders, do not want to accept it. One quick story to picture this is when you attend school reunion, neighborhood party, or barbecue party. Usually everyone asks about what is it you do, right? And you answered, I am a trader. Then everyone be like, oh okay, you are crazy risky, dude. Some others may ask whether trading is like gambling. The answer is yes. If you don't know what you do, you are literally a gambler. That is how society think about how risky trading is, and it's true. Trading associated with high risk by nature, the inherent risk. But, as professional trader, and yes you want to be that professional trader, they don't think they are gambler, even they don't think they are a trader, but they accept the inherent risk of trading and they think they are a professional risk manager. See, the first reason why many traders just giving away their money to the market. It is because the amateur and even seasoned traders don't apply risk management into their trading system. They don't want to accept if they cannot be right all of the time in trading. So, they don't do risk management. All they want is to prove that they are correct, to believe that their strategies will play out. Hence, understanding risk management is crucial. Risk management is not merely set your stop-loss order. There are metrics that we can use to make sure your risk management is correct and systemized. So, The first reason is always to remember to accept the risk of the trading, which means the way they trade always put risk management and trade management on top of their mind. Reason number 2, inconsistency leads to roller coaster result. Let me tell you one truth, many traders have great understanding about market, technical analysis, pattern recognition, fundamental analysis, and many other trading strategies, but there is a gap between their knowledge and result. Have you ever found a trader which have very good winning trade percentage? Let's say from 10 trades he wins 7. Seems amazing, right? You may think you can get hefty amount of money into your pocket with that winning percentage. But that's not for most cases. There are traders who barely break even when they have high winning percentage. See what is going on here? The possible reason this happens once again because the inconsistency of their trade management and the risk management. I bet we all know that we must play the trade without emotions, but the fact is sometimes we let the emotions get the best out of us when we are in the trade. We just forget to set the stop, changing the stop while in the trade, exit the trade too early because of fear, and random with our risk management. Well, does this story sound familiar? Every trader at least has been experiencing this in their trading career. I've been there and you may too. Even sometimes I still lost my temper when trading and give back my profit from numerous last trades in one trade. Even though I know how important risk and trade management are, sometimes I find it so hard to always be consistent. It is a tough work. But I learned some simple and effective plans to make your trades more consistent. It makes you know what to do when certain things do happen. So, I hope the plans I give to you in this video will address the inconsistency issue. So, to sum it all, risk management and trade management are always be the key factors to make you become professional trader who trades for a living. But, many traders discount it. It is not sexy topic to discuss like trading strategies, candlestick patterns recognition, and indicators setup. These topics easily become bestsellers for book, course, workshop, seminar, you name it, not like trading mindset, psychology, and risk management. Do not take it by mistake, trading strategy is crucial to be successful trader too. But, what really separates professional traders and amateur traders is how they manage their trades and risk. You can have top-notch high-probability winning strategy, but if you don't apply your trade and risk management in a disciplined way, you may not get the results that you expect to have. Because, you now know that lack of risk and trade management are the problems based on those two stories I told you earlier. So here we are going to discuss about what I know about how professional traders manage their trades and risk. I outline one primary goal for you as the viewer, which is to build the bridge between professional traders and amateur traders. If you still don't get the consistent result from your trading, literally you are not on the right track on your way to become top 10% trader who makes living only from the trading result. So, in order to become one of the top traders, you must know the main distinction about amateur and professional trader. You may get disappointed with my explanation, but from what I learned, the main difference is professional traders are more disciplined about how they execute their trading and risk management, which leads to consistent outcome in this uncertain market. So, the bottom line is, in order for you to become professional traders, you should become risk and trade management master. By being trade management master means you must be disciplined to follow your plan consistently. Now, how about you tell me if this sounds familiar to you? At this stage, you might be getting what are things that we will discuss throughout the video, and yes, that is the pathway many traders know paying attention to. The first two things you must do prepare so that you can get successful trading career are: risk management mastery equals how you preserve your trading capital in this uncertain environment with unlimited moving parts called the market. Trade management mastery equals how you manage your trade. It is more about your mental maturity to keep following your predetermined trading strategy no matter what happens with your trade. So, To help you mastering the risk and trade management, I divide the entire video into two. You can guess it, right? The first one is we are going to cover risk management. In the first video, I hope this will give you fresh perspective about how you see and accept the trading risk. Not only we will talk about mindset thing, I give you steps on how to take trade in regards with risk management manner. I am going to cover the whole risk management trading system here. Even I give the risk management tier system for you to follow, so that you can try it yourself, racking up from the lower level to higher one in controlled consistent progression without greed takes into account. With each level up, you will see your trading result like a rising curve, and that is what we all want as a trader. On the second video, we are going to discuss about trade management mastery. Just like the first chapter, I always give you the mindset first, like the trading psychology and trade management. After we discuss it, we jump into applicable stuffs. I am going to explain some ways to manage your trade. Don't think that I give you complex trade management plan. The market already complicated, so why we complicate things further where the simple and easy to follow plan already effective, right? Also, I will give you my personal trade management plan which you can copy or modify it with your style. It is more complex yet still easy to follow. It will reduce my loss and optimize my trade even further, so I can get the best return from my trade. Throughout the video, I also give you some homework assignments, so that you can practice directly to your trade after you receive the information. If you just learn without doing, your new knowledge will be forgotten easily, right? Well, last thing before we jump. Please subscribe, like, and share if you learned something great. Don't forget to click the notification bells too. Well, you still think that psychology aspect from trading is a garbage? Let me assure you one more time. This one is from equities analyst and financial manager, Glenn Curtis. He says that containing emotion and exercising discipline are key to making money. He told that there are many skills required for traders to be successful in the financial markets: the ability to understand a company's fundamentals and the ability to determine the direction of a stock's trend are two of them. But neither of these technical skills are as important as a trader's mindset, the ability to contain emotion, think quickly, and exercise discipline, what we might call trading psychology. The psychological aspects of trading is extremely important. Traders often have to think fast and make quick decisions, darting in and out of stocks on short notice. To accomplish this, they need a certain presence of mind. They also, by extension, need discipline, so they will stick with previously established trading plans and know when to book profits and losses. Emotions simply can't get in the way. Understanding fear. When traders get bad news about a certain stock or the general market, it's not uncommon to get scared. They may overreact and feel compelled to liquidate their holdings and go to cash or to refrain from taking any risks. If they do that, they may avoid certain losses, but they also may miss out on gains. Traders need to understand what fear is, a natural reaction to what they perceive as a threat, in this case, to their profit or money-making potential. Quantifying the fear might help, and traders should consider pondering what they are afraid of, and why they are afraid of it. By pondering this issue ahead of time and knowing how they may instinctively react to or perceive certain things, a trader can hope to isolate and identify those feelings during a trading session, and then try to focus on moving past the emotional response. Of course, this is not easy and may take practice, but it's necessary to the health of an investor's portfolio. Overcoming greed. There's an old saying on Wall Street that pigs get slaughtered. This adage refers to greedy investors hanging on to winning positions too long, trying to get every last tick. Greed can be devastating to returns because a trader always runs the risk of getting whipsawed or blown out of a position. Greed is not easy to overcome. It's often based on an instinct to try to do better, to try to get just a little more. A trader should learn to recognize this instinct and develop a trading plan based upon rational business decisions, not emotional whims or potentially harmful instincts. Setting rules. To get their heads in the right place before they feel the psychological crunch, traders need to create rules. They should lay out guidelines based on their risk-reward tolerance for when they will enter a trade and exit it, whether through a profit target or stop loss, to take emotion out of the equation. Additionally, a trader might decide that in the wake of certain developments, such as specific positive or negative earnings or macroeconomic news, he or she will buy or sell a security. Traders would also be wise to consider setting limits on the amount they are willing to win or lose in a day. If the profit target is hit, they take the money and run, and if losing trades hit a predetermined limit, they fold up their tent and go home, preventing further losses and living to trade another day. Doing research and review. Traders should learn as much as they can about their area of interest, educating themselves and, if possible, going to trading seminars and attending sell-side conferences. Also, it makes sense to plan out and devote as much time as possible to the research process. That means studying charts, speaking with management, if applicable, reading trade journals, or doing other background work, such as macroeconomic analysis or industry analysis, so as to be up to speed when the trading session starts. Knowledge can help a trader overcome fear, so it's a handy tool. In addition, it's important traders remain flexible and consider experimenting with new instruments from time to time. For example, they may consider using options to mitigate risk, or setting stop losses at different places. One of the best ways a trader can learn is by experimenting, within reason. This experience may also help reduce emotional influences. Finally, traders should periodically assess their performance. In addition to reviewing their returns and individual positions, traders should reflect on how they prepared for a trading session, how up-to-date they are on the markets, and how they're progressing in terms of ongoing education, among other things. This periodic assessment can help a trader correct mistakes and change bad habits, which may help enhance their overall returns. The bottom line. While it's important for a trader to be able to read a balance sheet or a chart, there is a psychological component to trading that shouldn't be overlooked. Being aware of how fear and greed can impact trading, exercising discipline, developing trading rules, experimenting, and periodically self-reviewing are crucial to a trader's success. Okay, move into risk management mastery. We'll talk about mindset first. Quick outcomes that I expect you to learn after view the first part of this free course are: the first one, what's so important about risk management and why traders should accept the inherent risk of trading. Second, what is risk unit and how to apply risk unit on your trading to effectively measure your result. Third, ROI versus are many traders using the false alarm to measuring their trading outcome, so you should use the right one, the professional traders use. Fourth, the compounding trading system using R. It is super useful way to make consistent profit on your trading account with one idea in mind, which is growth. These topics will set you the right path on how to manage your risk, so you will see steady consistent profits from trading. Many traders couldn't achieve that because they trade with get-rich-quick mindset. They really want to take on lots of trade, then make bunch of money, that's how they operate. With this reckless trading style, This type of trader experiences jet coaster result. Sometimes they make money over numerous trades, and then they give their money back at one or two trades, just ups and downs like roller coaster. In the end, after your commissions and expenses, you don't make any money or potentially losing some money, and or maybe you can earn a little bit of money. The professional trader for life is 10% of the industry. The cold harsh fact that many traders didn't make it to the consistent profit results. The truth is, many traders don't stay long on the market. They ran out of capital quickly, making them bankrupt instead of get decent living from trading. Like what internet shows you how great is the life of successful traders. That's what this free video course about, to help you to become professional traders for life. Make steady rising curve of your income which enable you to be around the market not just today, tomorrow, next week, next month, next year, but to be around for whatever time you want to hanging around on the market. Here's one quote that you should remember when trade. The one sure way to make consistent profits from trading is to be consistent in every aspects of your trading and always act in a manner which support your best interest. Like duh, of course I consistently trade, and always do in a way that support my best interest. But let me tell you, the 90% traders don't. They inconsistent in trade, in a random way, in a random market, and expect consistent result. That's not how it works. If you have trading strategy that wins 7 out of 10 trades, and you barely making money from it, trust me, you don't act in your best interest. You don't have risk management plan, you don't master risk management, that's why you couldn't get that consistent results. Why mastering risk is important. Understanding technical analysis, reading chart, pattern recognition, fundamental analysis, behavior levels analysis, and practicing them over and over again from the market are essential, but alone are not enough to make you a successful trader. See how I point this out very often? Yes, I am stressing this so much, because for beginners, when they start trading, usually there is one thought shows up in their mind. It's, I should learn everything about the market, if I can master it, then the rest is easy. But again, the cold harsh fact is the market is random. It has unlimited possibilities, there are unknown number of parts which move the market. So, could you learn everything about the market? Could you beat the market? The answer is straight no. Then what should you do now? In order to make this unlimited market more predictable, learn the analysis, trading system, chart, fundamentals. But, you must add one more powerful tool into your trading system to make your results more predictable. And the final piece of the puzzle is you must master the risk management, so that you can level up, from amateur traders into professional level. Have you ever experienced yourself having good winning streak and making good money from it, then on 1 or 2 trades you give all the hard-earned profits back? How were you feeling? It's not good, depressed, overwhelmed, stressed, angry. Seems very related to you? Yes, of course the answer is everybody who enters into this trading business experience this. The reason why this happens, especially in early stage when people start to trade, is they are focusing to make money. They implement what they've just learned with all of those strategies on how to read the market movement to make the money. It could work, you got a nice winning streak, start making some money, and it really boosts your confidence. You think this works, it's easy, I can do this. And that is when the greed comes out. You start thinking, how about I get into bigger trade more often, so that I can quickly double, triple my account. You start trade randomly, you trade recklessly, and you know the rest of the story. You may end up losing all of your profits with just only 1 or 2 reckless trades. Now I want to share to you about the trader journey. It starts with good trader, great trader, excellent trader, and on the top is outstanding trader. Well, it sounds like academic results, but it is what it is. First, you are good trader, you learn how to read the market, identify pattern, chart, learning about indicators, and good trader only get poor result. Then, from continuous learning and experience from the market, you start doing great. You keep learning and improving, start to know what's working for you and what's not working for you, revise your trading strategy, and start applying small risk management. By doing that, you start to get a good result. When you start to get good result, your both overconfidence and recklessness starts to play. And then you may end up being knocked out from the market and start it from the first stage again. But, can you start to see the pattern here? Your result as a trader is one step below who you are. Next is, you start to getting more experience, more consistent, even invest in mentor to guide you, learn thoroughly from him, so that when you start to deviate, there is someone who can alert you. Because of that, you start to be excellent trader. Now tell me, how's the result now? Yes, excellent trader only get great result. Then there is the last stage, the pinnacle of trader is to become the outstanding one. And the special thing about become outstanding trader is your result is not excellent anymore. You can take all the results. That means, outstanding trader unlike the others, has outstanding result. In order to achieve that, remember one thing I asked you to remember earlier. To be consistent in everything in your trading. So, the outstanding can be substitute for consistent. Hey, if you can achieve this, congratulations, you are one of the 10% of the top traders. Now, I want to ask, how about you? Which level are you in now? Do you already do the outstanding job in every aspect on your trading? Or are you still focusing only on one aspect, like learning new indicator rather than being outstanding in all areas? Think about this, because only 20% of trading are the technique, understanding the market, and analysis. The majority of trading itself are about your psychology, beliefs, and how you think like consistent profitable professional trader. How professional traders think. So, how profitable professional traders think. One thing I know is they think that the most effective and efficient way to have consistent profit is not to trade for money but rather trade to obtain skill. Wait, hold on, everyone trades to make money, add another stream of income, to have laptop lifestyle and living in their own terms, doesn't it? The problem is when you think that your trading objective is to make the money, the market will not give it to you, believe me. So, the better way to do it is to shift your mindset, think more like trading is to acquire new skill, use your acquired skill to stand on the top of the pyramid doing consistently and making the real profit. Now you know, the focus of your trading is not how much money I will earn, but more to develop the system to get the necessary skill, so you can advance further as trader, then you can actually make money because you have been consistent from the beginning. When you start small, there is lesson that we can learn from the casino owners about how they always earn money in the end. You know that trading has inherent risk that makes people think trading is same with gambling. And I told you yes, it is literally the same. You can think market is just like a big casino. And in casino, there is saying about the house is always win, which means the owner is always win. Whether there are gamblers that take so much money out of the casino, in the end the owner is making money too. If the market is just like the casino, then why not we copy the casino owner's edge? It is our end goal after all. To get the skill which enables you to consistently making money. So, how the casino owner does that? The simple answer is the owner believes in his strategy and play it over and over. The illustration that I can give to you is imagine a roulette. It is a wheel consists of numbers. The gambler bet the ball to fall on either black number or red number. If the gambler is right then he earns money, if not then he loses his bet. On a roulette, there are 18 black numbers and 18 red numbers. You may think that the gambler's winning chance is 50%. But here's the secret. There are two numbers colored in green, the zero number. Now, how big is the gambler winning chance? It is 1838, so it's around 47%. Then the casino owner winning chance is 53%. Well, it doesn't sound profitable, right? But here is the model that we can copy. Casino owners always trade in probability. Let's see, if the owner's winning chance is 53% and the loss is 47%, he has 6% edge for this roulette game. That 6% is the game changer. The owner believes in this statistical edge and let the game play on a big sample size. The owner expects that even his early games bring loss to him. He doesn't upset, because he knows based on the statistic, the more games he plays, the result will get closer to the proposed win-loss 53% to 47% probability that gives the owner 6% incentives. Start to see where the money is? Let us see what the table tells us. Let's say the gambler bet $1,000 to play this game. And from over 1,000 games played, the result would be 530 wins and 470 loss, or at least the result would be close to that numbers with small deviation. Then, from 530 games won, if in each game the bet was $1,000, the owner earned $530 grand. So, from 470 games, the owner lost $470 grand. Then, the net profit for the owner was $60,000 or equal to the 6% edge result. Still don't get it? Well, the main lesson we can learn here is no other than consistency. The owner believes he has 6% edge over big sample size. So, if you believe your strategy has good win-loss ratio, then you should let the strategy being played for over a size of sample. Don't let the first 4 trades resulted in loss affect you and then you judge that the strategy is not for you. Let the strategy play for more trades. Because like the casino owners, we want to trade in probability. You should believe that the more you put your strategy onto the test, the result will get closer to your proposed probability. Okay, let's get deep more to the risk management. Before you learn any applications which can improve the way you trade, one basic concept you must learn is to know what risk unit is. The definition of risk unit, R, is the amount of money a trader willing to lose on a trade when it hits his stop. Many traders don't set his risk unit before trade. By doing that, you may decide you're willing to lose X amount of dollar. Some people don't decide this in advance. They just think I will quit if it starts to look like disaster, or they think the numbers, like I will quit from the trade if I am down some X amount of dollars. Remember when I discuss about inherent risk in trading and its association with gambling in the introduction? Here I will give you the example. Most of people think that gambling is riskier than trading, but the truth is, the way 90% of trader trades is riskier than they just go to the casino and gambling there. In the gambling industry, they have some kind of handicap and safeguard to protect the gambler. If you go to casino, there is no casino game that you can go and play without deciding in advance how much you're willing to risk. All bet on the table. You can't say, spin the wheel, pull the card, pull the lever, then I will say how much I am willing to risk. You have to decide first, how much your bet is, $100, $2,000, $7,000. So, when the game starts, you already know how much you will lose. And then the game reach its end, either you win or lose. In order to replay, you must decide again how much you're willing to lose. So, in gambling, they force you to decide the amount of money you're willing to lose in advance, and when you are losing, you should be more active in taking plays. This means literally you should play more games to cover what you've already lost. See? In trading, most trades do not think the inherent risk, instead they tend to overconfidence, like, well, I know where the market will go, I know how to use this indicators, I see that this pattern is going to work, so I don't really need to think about the risk. because I believe that I am going to be right when I enter the trade. So, they decide to enter the trade and maybe it starts working like they think it will. Great news for them. But, what happens if the trade can go opposite to the direction they predicted before? They haven't decided how much they're willing to lose in the first place. So, they will rationalize, justify, hope, pray, and think more strategies in their mind in order to keep them stay in the trade because they don't accept the fact that the trade doesn't play out in the direction they originally planned. In trading, you can become a passive loser, rather than active loser like in gambling. To sum up, risk unit is there to help you how much you're willing to lose if the strategy doesn't work. Risk unit is also useful to determine the profit a trader would make on a trade if the target is achieved. Hence, this is how you establish risk-reward ratio. For example, you decide that your risk unit is $50, then your risk-reward ratio that you want would be around 2-3 risk unit averagely on every risk you place in every trade you take. Put it simply, if you risk 1 R, you expect to make potentially 2-3 or more Rs. Rs based on real gains or losses on trader's account, not a return percentage from trade you took. This is important because this shows not how much you invest in a trade, but rather how much you're willing to lose on that trade. You can invest any amount you want, $100, $500, $1,000 on a trade, but if the fact is you're willing to lose $100, then that basically what your risk is. So, you don't measure your return based on how much your investment was, but on how much risk you're willing on a trade. Introducing your new pal, stop price. Stop price is a point on the chart when the patterns or strategies you use are broken, hence the probability of the trade working as originally planned does not apply anymore. When you decide through your analysis whether you're going to trade long or short, and there will always point in the chart that telling you if your analysis don't make it. So, the pattern is broken. Then, it will go to opposite direction from your analysis. And that is where you want to put your stop price. Stop price is determined from the chart, not by dollar percentage. Let's say if you're gonna lose, you want to lose $100, so when you get down for $100 and then you will sell out, well, at least if you did that, it is better than someone who doesn't have his risk unit defined. However, this is not the right way to set up your stop price, because that some random number you came up with might not even showed in the chart when the pattern is broken. So, you must decide it in the first place, where you want to enter and when you want to put the stop. You must determine the stop price before the trade, no should, no can, it is a must. Always use hard stop to every trade until a target is achieved, then trail stop is acceptable. This means when you enter the trade, you already placed the hard stop in your system, so that there is no second guessing when to place the stop. If the price touch that point, yes, you will stop out of the trade. So, don't become passive losers. Be the active one. Sometimes the trades don't work, and it is acceptable, it is okay. Treat stops like your friend, not your enemy. Many traders hate stop, because sometimes they stopped out for no reason, the market just testing the price and then bounce up to the favored direction. And because of that, traders do not want to use stops. They will do the averaging method, or hope, and pray the market will go according to their plan. And here's why you must think stops is your friend. Stops enable traders to limit their losses and preserve their capital. So, the biggest reason people don't succeed in this business because they ran out of their trading capital. Professional traders do not adjust stops once they hit. They already place their risk unit in advance. And they don't change your mind when they are in the trade. Well, you can't do that while gambling, right? You can't just ask, well wait there, I didn't mean to bet that much. Can I take a portion of my bet back? Can I split it to the next round? Or hey, I got blackjack. I want to raise my bet on this play. That's the same for your stops. Once you decide to play, just sit there. Don't adjust the stops, because when you decide how much you're willing to lose before the trade, there is no more fear. After you know what is stop price, and how you should think and put your stops, now, I want to stress more about its relationship with risk management. The first point is your R makes you know upfront about your maximum loss. You know that most people don't think in that way? They come from the mindset which they are right, they really believe their strategy works. If you believe that you are right, is the risk management become your top priority? Of course not, because you expect to be right. But then again, it is so helpful if you already set your R, so that you know how much you are gonna lose in case your strategy didn't play. Furthermore, your stop price protects you from losing more than your R on a losing trade. Well, let's go back from early example about 7 wins out of 10 trades, then you didn't make any money, or even you burned some money away. Again, the only possible explanation is that you didn't define your risk unit in the first place, or if you already have, you didn't put the auto stop, so when your trade really moved to the opposite direction, you still hope and pray it will move back to the direction you planned, so you did nothing. But, when it really pushes the move closer to the point when you will lose money from your last 10 trades rather than earn money, your fear starts to come out. You will say, wow, okay, this is it. I don't want to lose my initial capital. Then you stop the trade. Tell me, this is what you think good risk management is? No, that's how you give all your profits back from that 7 wins on 2 or 3 trades. That is so wrong. Even I refer this to as emotion immaturity from traders' standpoint. We must emotionally mature when it comes to trading, because the market has uncountable moving part. So, with setting the R and the auto stop up front, you just limit your risk only just by 1 R. You won't lose more than at each trade. Upon entering the trade, you have completely accepted the possibility of the maximum loss. There is no fear. One of trader fear is fear of losing money. But yet people trade in a way like they lose money more than they need to. That means when you set the R you know how much you will lose and accept it, then take the trade. If it is a loss then take it too, and move on. If that loss amount, your R size, is too overwhelmed, you can't stand to lose that much of money, and when you lose it you just crying at the corner of the room, regretting everything. Even think that your life is a mistake. Don't go that far, guys. Then just simply lower your R. Don't make trading more complicated, just keep it simple, buddy. Next is, your R must always be the same amount for each trade entered over a preset amount of trading days or trades. If you set different Rs for every trade you take, trust me you might not get closer to long-term consistent profits that you want. This is so important, read it over and over again. For example, your R size must be consistent for like 30 days or for about 30 trades. So, you can't change it adjusting your mood and feeling. Such like, today I will risk $30, tomorrow $70, then the day after tomorrow $50 or hey I got 8 win streak. This is my moment. I will crank up what I'm willing to risk tomorrow. I will risk $300, $500, then jackpot. You lose all your 8 win streak profit from the 2 inconsistent R trades. Keep it steady and the same for predetermined time or trades. By implementing this one hack, it can change your trading result in a positive way. To achieve the overall results you want, you must let your analysis play out on each trade with the same R. You can just pick and choose which trade is gonna work better. It's impossible, isn't it? There are just unlimited variables in the market, you just can't know exactly where is the highest high, where is the lowest low, so professional risk manager always keep his risk same. Because the outcome of the trade is always uncertain. And to make your result have more certainty, The one way to do it is to bet the same amount of risk on each trade. And if you do that, your predetermined acceptable risk unit removes all the emotions once you enter the trade. So there is nothing to fear. If you can afford to lose $50, you set it. If you lose it, it's just okay, no hard feeling, discomfort, explosive emotions whatsoever. You have done the analysis, set your risk unit, take the trade, then there is nothing you can do, just wait and see where the market will take your trade. Let's go to the next slide for the example how consistent our amount will lead you to more profitable outcome. In here, there are two traders assuming they both have $50 risk unit to place on every trade. Now this is the story of the first one, the inconsistent trader. The first trade taken on Monday. In the morning, Trader 1 woke up and feeling tired. He didn't feel good. He also think, this is Monday, the market will set the direction first, might not have a good chance to get real result today. So he instead of risked $50, the amount he should have risked, based on his feeling and emotion, he risked $30 on that day. And the result unexpectedly great. He cashed out 3-hour winner trade, so he earned $90. Then the next day, wow, yesterday was out. Today I will do what I should have do. He risked $50 on the trade then got stopped out. At least he already set the R, so his loss limited to 1 R. Tomorrow, he started to think from the money perspective. On Monday I got $90. Yesterday I lost $50, so I earned $30 net. If I'm going to risk $50 today and then get stopped out, I will lose money. No, I don't want to lose my capital. So, I will risk $30 today. Like his thought, he risked $30 for that day and came out with 2-hour winner trade for $60. And for the next day, the trader felt confident. He believes he can make it happen after yesterday winner. So, he risked $50 and the result is loss, so he gave up the $50 to the market. That is how beginner trader think, they trade with money mindset. Yes, it is the right thing to preserve your trading capital, but this trader in the example used the wrong technique. Ultimately, beginner trader always decides the next trade based on the result of the previous trade. Like this trader, after he won, he raises the risk unit. And if after he experienced loss, he lower the risk unit. How about the other one? The consistent trader. Let's see how well his result because of his consistency. On the first trade, no matter what happened, I strict to my rules, so I risked $50. With the same result as the first trader, he gained 3-hour winner trade for $150. The second trade, always stick to the rules. The consistent trader just want to test his trading strategy whether it works or not. He risked $50 and get lost trade with minus $50 from the account. Third trade, risked $50 again and again. The result was 2-hour winner trade, so he got $100 into his account. And the last trade, always risked $50. The result was he stopped out, so he gave away the $50. Now do the math, with the same trading outcome with inconsistent trader, the consistent one made $150. Compare it, $50 versus $150. It is whacking 300% difference in profit. So, the consistent R method is really works. The discipline and emotional maturity in trading will pay you good dollars. And yes, it takes the integrity to always stick to the rules you created yourself. So, try to do this, and let's see what happened to your trading result. The metric battle, ROI versus R. Most of beginner trader always measure their results using ROI. Yes, it can give you data that reflect your profitability. But ROI is not good measurement. Instead of using ROI, Traders should start using R. Here is why you should not measure your trading results using ROI. ROI keeps you focused on return for the trade. This obvious, return on investment always measure your profit, thus ROI makes you neglect the predetermined risk that you must decide in your trade. When using R, it is as simple as I am willing to lose 1 R unit and my target is 2.5 R unit. But, if you use ROI, you just focus on the return. You just want to target based on your capital gain. What I am trying to say is when you use ROI, you just take into account the return factor only. But, when you use R, first you always come up with your acceptable risk, then use that risk to measure your profit target. With this you are not taking into account the return factor only, but you included the complete factor, which risk and return factor. The amount of investment is irrelevant without risk. Let me give you an example. Stock ABC, the current price is $50, target price at $65, and stop price at $40. The position size is 10 shares. So, it is $500 entry trade and $650 target. The question is it a good or bad trade? The answer is I don't know. From return perspective, your investment will be $500, then you get $150 profit on this trade. So, it is 30% ROI. Incredible, right? Well, yes, except how much the risk amount on this trade? This is the missing piece most beginners don't decide in advance. Let's say the risk unit is $100. In order to make $150 profit, you risk $100. So, it is 1.5 R. Well, it is acceptable, so yeah, it is an okay trade. But if the trader willing to risk $500 investment to make $150, would that be a good trade? It is not interesting as we hear it in the first place. It is a bad trade. The odds are just against you. You have to have super very high percentage betting average to ever make any money. So good trade or bad trade is really depends on the risk factor. That's why the amount of investment you enter is irrelevant without determining the risk in advance. Put it simply, ROI does not give you overall measurement of your trading. Trading using ROI is dangerous because of all those reasons I previously mentioned. So here are benefits of trading using R. First, why you should measure your trading results using R. R2R measurement makes sure you always be consistent. On day trading, I have target to make profit in 8-10 R in a week. Not in percentage, not in some amount of dollars. It is just 8-10 R, that way keeps your eyes and mind to always be consistent. Remember, to be outstanding you must consistent. Trading with R removes the emotion of money. Because with R, you are not thinking about how much you invested. It is about how much you accept your loss if your strategy doesn't work. So, there is no fear, no emotion playing while you on your trade. It is just set and go. Either you hit your target or hit your stop point. Trading with R keeps your losses limited to same amount. I think we already covered this before. When you have determined your risk unit, you only can lose that 1 R if there is anything wrong happen in your trade. This will keep you stay long on this business. With R, trading is like exercising. R builds your muscle to make your profits bigger and controlled way over a set period of time. At start, your R should be small. Then you start doing your plan and consistent about it. If your account size grows more and more, the compounding rules starts to apply. You can determine bigger risk unit. Make your profit size grow nice and steady with consistency. So, you will not experience the roller coaster result, hoping for one big winning trade and then give all your previous profit back. It is just like turtle and hare race. It always the turtle who wins, slow but sure. Ironically, many of the traders want to be the hare. They came from get-quick-rich mindset, even though there is slim to none chance you can be consistently profitable from trading if you have that kind of mindset. And I never heard any trader's success story with this get-rich-quick approach. How big your R is. Trader's R should be around 1% to 2% of their capital in his account. For beginners, 1% is recommended, the safe number. As you get more experience and learn how the market moves, learn how to identify and execute your trading plan flawlessly, you can increase to 2% per trade. So, for example, with $2,000 account, 1R equals $20, the maximum 2R is at $40. With $10,000 account, 1R equals $100, the maximum 2R is at $200. Many of you might don't like about this idea. Because you gotta start small. Before you know this information, maybe you already think about your R size. You might think around 5% or 10%. That's enormously big. Even professional traders I know rarely go to 3% risk unit size per trade. I only tried it for around 3-4 times. 1% change really have significant impact on your account. No matter how big your capital is, even you already have spare money to inject it later in the middle of your trading career, still start small. Maybe you clever at making money and having big reserve on your back, but don't be stupid enough to give it all to the market. Now you know how big your proper R is. So, how about we start to working on how to deal with loss and risk management manner. For example, you have $2,000 account. And you know your R size is $20. Then how you must deal with losses? First, limit your loss per trade to 1R, $20. By consistently apply this value at 1%, you will run out of your cash in your account if you lose 100 times consecutively. So, this trick will surely keep you stay on the game for a long time. If you are day trader, limit your loss per day to 3R, $60. So, in one day, I never lose more than 3R. If I have 3 losses in a row, then I call it a day for trading. I close my computer and doing something else. I don't say well it is still 11 in the morning. Maybe there is big move at 2 p.m. Even though I already lost 3R, maybe I will stick around for one trade. Just know. That is reckless. I am just out, because I am risk manager. I already set my plan on how much I'm willing to lose in a day, so I respect my own rules. Limit your loss at 7R, $140, a week. If you have 3 losses each on Monday and Tuesday, then early on Wednesday you get 1 loss to add on your loss collection of the week. You know what to do. You quit from trading for the rest of the week, and start fresh next week. Just remember to always be consistent and respect your plan. R and trading size. As risk manager, you always put your best interest at preserving your account capital. In order to do that, you must determine how many shares, contracts, or lots you buy based on predetermined R you've just decided. Why? By determining this, your loss will be limited to 1R every time the market enters your stop point. So, you only can just lose 1R like the plan we already discussed, which is limit your loss to 1R per trade. Here's the formula to calculate your trading size based on R in stock and Forex instrument. In the next slide, we will break it down with examples, so you can use this formula later after you watched this video. For stock, your shares number should be determined with this simple formula. Number of shares per contracts to buy equals your R value divided by your stop distance. Your R is determined by 1 to 2% of your trading account. Your stop size is price difference between your entry point and your stop point. The example is if you want to buy stock at $15 and then you set your stop price at $14.50, so the stop size is 50 cents. Here's the examples for calculation. Your trade size, $20 divided by 40 cents stop equals 50 shares. $20 divided by $2 stop equals 10 shares. $100 divided by 40 cents stop equals 250 shares. $100 divided by $2 stop equals 50 shares. Let's say you have $20,000 trading account. You are a bit aggressive, so you have 2% risk tolerance. You want to buy a stock for $24 per shares. Based on your analysis, your stop will be placed at $20. Then, the number of shares you should buy is $20,000. Multiply it with 2% divided by 4, which is I get from $24 minus $20. And the result is 100 shares. For Forex, your lot size should be determined by using this formula. Number of lots you buy equals your R value divided by your stop distance in pips. Multiply it with dollar value per pip. Your R values is the same like stock formula. It is based on 1 to 2% of your trading account capital. What different is your stop distance here measured using pips? Let's say you take long position, you buy Euro USD for 1.3120, and you expect the pattern to be broken at 1.3100. That means your stop distance is 20 pips. Then dollar value per pips number is different based on pairs you currently trade. If you are trading Euro USD like the example, the value per pip is $10. Other pairs have different value, some are less than $10, some are higher. So, how do you know the value of the other pairs? Just search it on the web, or you can just use Forex sizing calculator. There are lots of the calculator now on the internet. Just pick one and enter your R value, your stop distance in pips, and pair you currently trade. It will generate how many lots you should buy based on your risk information. Example. You have $5,000 Forex account. Currently want to enter trade on Euro USD pair, with 1% risk, and 15 pips stop distance. Then your lot size should be equals $5,000. Multiply it with 1%, then divide it with 150, which is I get from 15 multiply with 10. The result is 0.33 lots. Then the last instrument I want to cover is option. We will go discuss more thoroughly into option than stock and Forex because option is a derivative product. Soon, we will cover about what primary Greeks for option we want to look for and how to trading are using options. For you who haven't heard or familiar with options, here are quick explanation about what is option and why trade stock using option. Option is defined as contract to buy or sell an underlying asset, usually stock in a size of 100 shares of the stock per contract, at a predetermined price, and by a certain date. There are two types of options. Just like stock, you either can buy if you think the price will rise or sell when you think the price will drop. So, there are call option, which is a right to buy the option, then there is put option, which is right to sell the option. But instead buying or selling the stock right away, when you buy an option you only buy the contract or the right. Here are some things you can do when you buy an option. Buy or sell shares of a stock at agreed price, the term for the price stated in the contract is strike price, for a limited period of time. Sell the right to another investor. Let the option expire and do nothing about it. Remember that option is just the right to buy, sell. If you don't want to use your right, then it is okay. Why trade stock with options? As savvy traders, we always consider the benefits and costs when we about to make a decision. So, why using options? Here are the benefits. When you buy the option, it only requires smaller investment up front than buy the stock directly. An option gives time to trader to see how the market moves. Traders can analyze whether their strategy will play out or not. Option protects traders by locking the price without the obligation to buy. The example of how options will help you. If you have a target stock and believe the stock is going to crank up in price, you can buy call option to gives you right to buy that particular stock shares at agreed upon price at a later date. If your prediction is right, if the stock price rocketed, you can buy that stock for less than its price in the open market. If it does not, your losses are limited to the price of the contract. Options can be used to mitigate your exposure risk on stock positions you already have. If you own stock which you are worried about its short-term volatility getting you stopped out with no reason, you can hedge those losses with buying put option. With this it gives you the right to sell that stock at particular shares and price. If the price really does shrink into opposite direction, the option limits your losses. In fact, if you buy the right contract, the gains from executing the contract help outnumber your loss. Based on the example about what option can do for you, options can be your guardian angel if you are treating the options as hedging instrument to your stock. But, if you are an option trader, which is what you are doing is buying and selling the contract, there are more risks involved. So, there are two main trade categories which option traders do, directional and non-directional option trades. You may already have heard about two directions of option trade, which is directional or non-directional. Put it simply, the directional option trade is when you expect a stock to be bullish in price, you buy the call option, and if you expect a stock to be bearish, you buy put option. This is what usually most option traders do. Because, when the stock price is rising, the call option price tends to appreciate, and when the stock price is tanking, the put option price tend to depreciate. In contrast, non-directional trades is generally suitable when you are not sure where the stock price will go, because of its enormous volatility. Later in this chapter, we will get to know how to calculate your maximum loss potential with options. And then compare it with your personalized R value to determine how many contracts you should buy, so that you would act on your best interest, especially using the directional option trades. As I say earlier, if you are options trader, there are more risks involved with this model. So, what are they? Well, there are popular issues with options which makes it harder to make your account grow with options trading. Your delta will change as the stock begins to approach your target of stop. Time will immediately begin decreasing the value of your option, theta. Volatility sometimes can be unexpected, 4. Then, what should you do? Trading options or not? Well, before we continue, let me ask you a question. You could choose to pay attention to everything you don't know about future option pricing and decide to get the risk management out of your door. Or, we can laser focus on what we already know and make some highly educated expectations in a way that is systematically consistent to help smooth out these unknown issues that exist on whatever vehicle we use to trade, particularly in this chapter is for options. So, what we already know. We know that as trade moves in our favorable direction, the delta will be improving, which means we are making some cash. On the contrary, when the trade moves to our unfavorable direction, the stop, our delta will be decreasing, which means we are losing less money. We know that if we are entering low volatility trades, an increase in volatility will only improve the value of our option. By all things that we already know, we can use common sense to estimate close our calculations. Primary Greek that you should pay your attention most. Unlike trading stock which have unlimited factors to determine its price, option price being determined by some of these elements. Delta and intrinsic value. Theta or time decay. Vega or volatility. Less significant factors like current interest rate and current dividend rate. I want you to imagine that you are trading in an environment that random in nature, has no certainty where it will go because it has unlimited moving parts in the stock market. Then you as a trader trading with directional options which also don't have a lot of uncertainty because there are lots of price determining factors. So, imagine trying to trade in random market with vehicle that has little certainty, and expecting to get consistent result. It sounds a little bit impossible now, but there is a way to do it. That's what I will tell you in this chapter. How to normalize your options trading top give you a strategy, so that odds are more in your favor. As I say earlier, if you are options trader, there are more risks involved with this model. So, what are they? Well, there are popular issues with options which makes it harder to make your account grow with options trading. Your delta will change as the stock begins to approach your target of stop. Time will immediately begin decreasing the value of your option, theta. Volatility sometimes can be unexpected, 4. Then, what should you do? Trading options or not? Well, before we continue, let me ask you a question. You could choose to pay attention to everything you don't know about future option pricing and decide to get the risk management out of your door. Or, we can laser focus on what we already know and make some highly educated expectations in a way that is systematically consistent to help smooth out these unknown issues that exist on whatever vehicle we use to trade, particularly in this chapter is for options. So, what we already know. We know that as trade moves in our favorable direction, the delta will be improving, which means we are making some cash. On the contrary, when the trade moves to our unfavorable direction, the stop, our delta will be decreasing, which means we are losing less money. We know that if we are entering low volatility trades, an increase in volatility will only improve the value of our option. By all things that we already know, we can use common sense to estimate close our calculations. How to calculate R for options. As option traders, we are expecting the underlying asset to move in line to improve our options value. The primary indicator to determine the price movement is delta. Delta is the relationship between the movement of a stock with the movement of the related option. Quick tip. Ideal delta is 0.70. 90. You never want to enter a trade with delta lower than 0.50. So, if your delta is 0.50, then every $1 movement on your underlying stock will make your option move 50 cents. Again, if the delta is 98, then every $1 movement on your underlying stock will make your option move 98 cents. Okay, back to the core of this book is to get a better understanding and how to manage your trading risk. For this purpose, we are going to use this one of the primary Greeks, delta, to calculate R. The example. Based on your analysis on your chart, you want to take short position on JKL stock, which has entry point $60, stop $63, and target $54 with delta 0.68. So, how many contracts you should buy? First, if your account size is $10,000. With 2% risk allowance, your R value is $200. Second, calculate your maximum predicted loss. Maximum predicted loss equals delta multiply with shares, then multiply it again with stop distance. So, the share is the size of the contract. Usually one contract is for 100 shares of the stock. If you trades many, then change it to 10. Stop distance is price difference between entry price and the stop price. And the maximum predicted loss is 0.68 multiply with 100 multiply with 63 minus 60 equal to $204. Hash contracts you should buy is max predicted loss divided by risk unit. So, on this contract, if you get stopped out, you will lose $204. If your risk unit is at $200, then how many contracts you should purchase? The answer is one contract. Whatever the predicted loss number is, always compare it with your R value. If your maximum predicted loss is like the example, $204, then your R value is $100. You will not buy any contract. But, If your R value is $800, you might want to purchase 4 contracts. By calculating your stop based on delta, you make sure that you are working with the maximum loss potential. The good thing is, when the stock price moves to your intended direction, it will only improve the delta in your best interest. And that will make 2 or 3R target will be achieved with your directional options. Quick recap about what we have explored so far about trading with risk unit R. How much your R should be. Simple plan on how to dealing with loss from our perspective. And determining your position size while takes R into account specifically into numerous instruments like stock and Forex. Pretty good, right? Maybe you already get ideas about how to improve your risk management plan by apply those hacks into your trading system. Okay, to make you easily review what we've just learned, I outline rules about trading with R in general. This rule must be respected and done with discipline. If one day you follow the rules and the other day you don't because you rather follow your hard content, then you still not ready to be the outstanding consistent trader. And if you don't like rules, you don't want to be strained, or think that rules made to be violated, just remember, in order to be succeed in unlimited possibility environment, you must have rules and more importantly to follow. So, here it is. Trading with R rules. First, stop price is always predetermined through analysis on your chart. Second, R unit is always determined by your current account size. Third, the size of your entry is always calculated based on your R unit and stop price. And fourth, that there is no special case, exception, unless, maybe, in case, or unless this happen. Just stick with it. Hey, what about quiz time to test your understanding? Don't worry, if you are wrong, you won't get bad grades. It is better to get wrong now than to be wrong when you enter your trades. Let's get to the question, shall we? When do you decide a target point for your trade? A. Before enter the trade. B. After enter the trade. C. While the price is moving toward your intended direction. Yes, the answer is A, before we enter the trade. Well, why is it important? Because this related to being consistent. Your target price and stop are crucial items that decide whether you take the trade or not. This related to risk-reward ratio. My magic number is minimum risk-reward ratio to be around 2-3R. That is when you want to enter the trade. Steps to trading with R. Here are steps to trading with R. I keep it simple with just 5 steps. Market is already very complicated, so why don't we simplify things? Why we want to confuse ourselves with complex and complicated trading system. Step 1. Determine your R for each trade to be used consistently over a period of 1 month or 20 trades, whichever comes first. Step 2. Determine your entry price and stop price based on the chart and your strategy. For example, buy AAA at $20 and stop at $18.50. Step 3. Calculate how many shares, contracts, or lots to buy using the formula, which is your R divided by your stop distance. Step 4. Identify target based on the chart and calculate risk-to-reward ratio. Step 5. If risk-to-reward ratio is fit with your trading plan, which is around 2-3R, then enter the trade when the pattern triggers. Will always find its way to create conflicts in your mind. You will always have reasons, experiences, emotions, to make you change what you have predetermined. But here's the thing. Regardless of how perfect the pattern is, how all those lines and indicators perfectly aligned, how strongly you confidence about the trade will play in direction that you think, how badly you want to prove you are right, the underline is that unless a trade has a reward to risk ratio of at least 1-2, it is not the best trade to risk in R. Here you go, you get the bottom line right? Take the trade with at least half potential 1 to 2 risk-to-reward ratio. Why? Refer back to the casino owner story. As far we discussed, the way that casino owner makes money is because he has statistical edge around 6% of the game. That is why he trades in probability, because from 100 games, he most likely made money around 6%. But, in terms of risk-to-reward ratio, the owner's ratio is 1 to 1. So, in order to make $1, the owner risks $1. Thus, the owner doesn't have the edge on this particular thing. The owner's edge is solely based only on the game winning percentage. By looking at that example, don't you see there is improvement that we can do in this business model as a trader which a casino owner can't do? Unlike the casino owner who can't change the nature of the game with its 1-to-1 risk-to-reward ratio, we as traders can. We can choose which trade that give us more edge to grow our account. We can be picky about our trade. You can set the minimum risk-to-reward ratio for the trade you want to enter is on 1 to 2. Or maybe you can set the standard higher, like, you only take the trade which has potential 1 to 3 risk-to-reward ratio to ensure your long-term win. If you have difficulties to find 2R or more trade, that is not true. There are many possibilities lying around in the market to make a 2R trade every day. Why entering trade with 1-to-1 risk-to-reward is such a bad idea? Just think about it more like this: if you have a child, then your little 8-year-old son come to you with his innocent voice asking, "Daddy, can I borrow $100 from you? I will risk it all at once to make another $100. It is either get the $200 or I lose all the $100. You would be like, "Son, that's probably not good way to do it. It is too risky. The odds are just against you. I won't let you to do that." So, if you won't let 8-year-old boy do it, then why you do it on your 30, 40, 50, or 70? You have to set your trade to ensure your win with higher risk-to-reward ratio. Hey, another quiz time. The question is, what winning percentage do you need to consistently earn money? A 30%. B 40%. C 50%. D 60%. E 70%. The answer is B. 40%. Now the question is, how is this possible, right? That does not make any sense. Even from the casino owner story, he has his statistical edge. His roulette game has 53% win percentage, that's how he makes money from over big sample size of games played. So now you tell me, can you make consistent money with less than 50% winning percentage? Traders in the world have 50% winning percentage from their strategies. So, in order to become consistently profitable is not because their analysis is top-notch and works every time, but it because they set up their trade to win. They determine their R properly, they trade their R consistently, and they only enter the trade with preferable risk-reward ratio like I mentioned before. Let me give you the example how you can make consistent money with 50% winning percentage. There are two traders are trading a $500 as their one risk unit. Look at how both of two traders already did great job. They predetermined their R and consistently using their R unit. What separates trader 1 and trader 2 is how they pick which trade to enter. I might say trader 1 tend to be more picky, because if the trade doesn't have risk-reward potential more than 2R, he won't take the trade. Just look at the end result. See the huge difference? It is based on same risk unit, same consistently placed stop at 1R and honoring it, and same 50% winning average. So, the result difference is only because of the trade choice. Another example is if you have 40% winning percentage strategy and you only take trade with 2R risk-reward ratio. So, from 10 trades, you win 4 trades, then your revenue is 8R. You lose on 6 trades, so your total loss is 6R. By doing that you still make profit about 2R in the end. You know now, if you can make hefty amount of cash, even your strategy has at least 40% winning percentage. You don't have to be right most of the time. Truthfully. It is so hard to do that. The market has unlimited random variables which are changing every second, so you just can't be right all the time. And again, how's this consistent money making possible? It is because of you set your trading to win. You only take trade with reward potential at least 2R. And by doing this, you do better than a casino owner. Wrap up on risk-reward ratio and its effect to your account's growth. First, trading 1-to-1 risk-to-reward ratio requires high winning percentage on your trading strategy to get consistent profits. Second, in addition, it needs you to enter more trades to make any significant result, which is more trades is reckless and equals to more commissions fee and more exposure for your error and mistakes. Third, you must narrow your focus and mindset to take only trades that have realistic potential to reach at least 2R target. Compounding risk management system. It's been a good ride, no? We already discussed a lot. At the end of this first lesson, you should already know what is compounding risk management system. If I am about to break it down into points, here's all key points of compounding risk management system. The first point, individualized and unique risk management system. Compounding risk management system is personalized and unique to each trader. Every trader has their own acceptable R value. By making it personalized to your own liking, the expected outcome is you should be more disciplined to follow the rules. Well, it is not 100% rules-free. There are some rules from the system that you must not break, that is R value is no more than 3% of trading capital. Second point, systemized plan that enable a trader to get skill and develop consistency in their trading. It's crystal clear now. I have babbling around about why you should not have mindset like trade to make money and get rich quick shortcut. All you want is to acquire a skill. Skill that can help you to have better living, and to gain a skill like that, it is not easy. I am still learning too, just like all of you. It needs to be consistent to get that skill, to get that outstanding trader level and outstanding results that you want. Third, plan which removes the emotion of dollar counting or trading for money mindset. When you trade with R, instead of speaking in dollar terms, we always talk about R. Psychologically, it will be easier for our mind to get rid of the fear of losing money. Also, you already accept to lose 1R from the start, so with this strategy, you can be more relaxed while trading. Fourth, plan which rewards your discipline and consistency and increases your R after you achieve certain goals. It is just like train your muscle. You will start with small weight. After you diligently do the training, your muscle starts get bigger, so it is ready to take more weight. Do it again and you can add more weight to come. Same with trading, start with small R, follow your trading R rules, your capital starts grow. Then now you can set bigger R value to increase your account growth even further. Fifth, plan that grows your account without the massive pullbacks. With consistent manner, it will prevent you to not experience that frustrating massive pullback, that roller coaster result. So, it is a safety guard plan that protects you to act in your best interest. Before we end the lesson in this video, I want to give you a homework to evaluate your trading system. Use your updated knowledge about risk management and assess your trading system, whether it already applies great risk management principle or not. So, here we go. First, get a screenshot of last 3 trades you entered. If you haven't took any trade yet, just open the chart and start to analyze the chart based on your strategy. Second, mark the entry, stop, and target. Pinpoint these 3 items on your chart. Did you set your stops? If not, Try to determine your stops based on your chart. Hint: to determine the stop is when the pattern broken. Last, was the risk amount for each trade the same? Calculate how much you risked for each trade. Were you being consistent? Trading journey with compounding risk management system. Everything about determining your R value has been covered. You already know how to calculate your R value for stock and Forex. Then, I outlined about how you should consistently use your R size over a period of time or trades and show you the example of how consistency will get you results that you want. Then again I emphasized about how important for you to be picky about when to enter a trade, especially if the risk-reward ratio won't allow us to set for our trade for winning in the long term. Now, I want to guide you more about how you progress every week and know when you should increase your R size, so that what you see is rising equity curve when you draw your trading results. Feels the result of your discipline, consistency, and the power of compounding R system. Back to trading journey. This is an interesting and unique topic, because it lets you view trading as a journey. You view it just like a career. You should view it in that way though, because it is the real career, real business, not some get-rich-quick scheme that people craving for. There are many people out there who are currently working or has worked then jumped into trading world, making trading their full-time career. No wonder, because one attractive aspect in trading is you truly get to be your own boss. However, you have to be smart managing your trading business to align with your best interest, so that you can advance further in this career path. You absolutely don't want to accelerate, throwing your capital at full throttle from day one, then you blow your account. What you want is steady progression along your way, just like the turtle. And that is what trading journey with compounding R system will allow you to do. So how do you record your progress in your trading journey? Well, I prepared a journey table template for you to begin to work with, but you might want to adjust it uniquely according to your trading style, whether it's day trading or swing trading. The aim for this trading journey table is allow you to promote yourself as you are getting consistent and as you acquire a skill. And when you do it that way, you will start to see your trading account growing with that nice rising equity curve. So this is template, you can see it below. Here's how we do. First, measure your progression by account size. In the example, I wrote that your beginning capital around $2,500 to $3,500. Doesn't really matter how big your account size is. Just put it there. Then the R level is $50. Well, if your starting balance is $2,500, the $50 applies rule of maximum R value must be not more than 2% of your trading capital. If your beginning balance is $3,000, then what I suggest is stick to the $50 R value. Why not start with 2% of $3,000? Because I believe you gotta start small, you need to train your trading muscle, and when you do this, I am more confident about you can reach that long-term consistent profitability. So what I recommend is everybody starts with $50 R size. Even when you do demo trading with $10,000 account, train it like you actually trade with real money by using $50 R size in the beginning. And then your maximum loss per trade, which is undebatable, always 1 R unit. No matter how big your account is, you always want to risk 1 R unit. The max loss per trade in R unit is fixed. Then R size is the variable that you would increase over time as you progress towards your goals. Next, the max loss per week. Just start small in the beginning, alright? Limit your loss to 2 R. If you out of 2 R, then quit the market for the rest of the week. Remember to be disciplined and follow your own rules. There is no room for what if, I think, I expect. The chart shows golden opportunity, and any other reasons. Just quit. Now about the target. At first you can set your target per week into 3 R, then target for the following month set to 5 R. Then, the last piece of the table is monthly profit target. I think most of you are looking over here. It says $250 for 1 month and you say, come on man, I didn't enter to this business expecting to earn $250 a month. I absolutely get that. I am a trader too. I know what it feels like. I am getting in your shoes. So let me tell you cold harsh facts about trading again. There are many traders who read this book and also not read this book have not make $250 consistently. Yes, it doesn't sound very exciting to hear you only earn $250 for 1 month. Even many of the traders do not even make $250 a month, ever. They never reach to the point of profit for a month. Again, if your mindset is about trading to make money, you won't earn it. So, just focus your objections to acquire skill and be consistent. Get the bigger picture of you want to stay long on this business. That's why I wrote this book. I want to help you to progress in your journey as a trader. Once you pass the level 1, $50 or size, which you can get through in 3 weeks or as many weeks as needed for you to be consistently achieve your R target, you now able to promote yourself. Say no more to wait your boss to give you that promotion opportunity or wait for your manager to get out, so there is vacancy in the upper position. You get the ability to advance to the next level in your trading career in a controlled systematic way. On the level 2, your account size should be around $3,500 to $5,000. Now to grow your account more, you increase your R value to the $70 and use it consistently when your account size around $3,500 to $5,000. The maximum loss per trade is always the same, 1 R. Then max loss per week still limited at 2 R. For the target per week, increase it a bit to 4 R, and target per month to 6 R. So, at the end of the month you start to see your profit growing to $420. Another level up, now on your level 3, your account size on the level 3 around $5,000 to $7,500. Now you eligible to set 100 R size for each of your trade. The max loss per week is 2 R. Then again, you increase the R target a bit to 4 R for profit target per week and to 5 R for profit target per month. So that you would expect to cash out $800 for the month. Maybe you wondering, why would I set the target to continue rising little by little for each level? Because as you level up from one level to another, you build that trading mental muscle, you are starting to get the consistency. After 3-4 weeks of that muscle building training, you earn the right to increase the amount that you're willing to risk. In order to grow even more, you now can set bigger target, which allow you to take more trades without being reckless. But the number of the increases must be risen at controlled manner. We don't want to get rich quick here, we want to train to execute our strategy, our plan consistently. And by the time you can master this, then the outstanding result will follow. Bravo, advance to the next level. Now you are more proficient with analyzing your strategy, picking trade which have good risk reward, consistently play out all of your strategy and risk management, then you raise your R unit to $150. Max loss per week still limited to 2 R. Target per week increased to 6 R, then target per month now 10 R, which is $1,500. Now, why I haven't increased the maximum loss per week? Why it is still at 2 R? Well, maybe you want to increase it to 3 R. But remember to trading which support your best interest. There are proprietary companies which put together the progression table for their traders. As the traders increase in level, they increase their maximum loss per week. The idea is to let they learn the skills more, to test their consistency, but what can be happen is as they increase their maximum loss, it opens the opportunity to make the trader become reckless in some cases and give all the profits back in 1 or 2 trades. That's why I suggest to leave it to 2 R, so that you are not giving back your hard-earned profits as you are continuing to rise your equity curve. You may increase the maximum loss per trade in later level, when you really be consistent and execute your trades flawlessly. So, you get it now, you just keep increasing your risk unit and target as you advance to the next level until you become comfortable with that risk unit. If you already comfy with $300 or size, then stay with it. See, as you increase the level, the money goes up. That is how you trade consistently. You are not trade for money anymore, you trade to get the skill, and by doing that, the money will follow. You can't run before you walk. Be patient, do the trading in the consistent manner. It will allow you to build the skill necessary to think and trade like professional trader, then actually see the results. Rules in your trading journey. Rule number 1, everyone starts at a $50 or value. Why start at $50? Because our objection is consistency, not making money. So, build that mental muscle of yours from small. If you earn the right to advance to the next level, you can train with bigger R. Rule number 2, the R level can be increased after successfully reached your R target profits for 3 consecutive weeks. Rule number 3, your account size should meet minimum requirements of your new R size. If your R unit is $100 and want to step up to $150 after reached 3 R targets consecutively, your account size must be at least $7,500, so that your $150 R value follow our maximum 2% of trading capital rule. Rule number 4, whenever you have stopped on maximum week loss for 2 times in a row, lower your R size to the previous level. Let's discuss these rules for a moment. You may think, hey, this is great, I have clear guidance about how I'm managing increasing my R size based on the outcomes of my trading in controlled way. Yes, it does help, but don't get too strict with these rules and prevent yourself to progress further. Let's take a look at rule number 2. It says that you must not increase your R value if you haven't made your R targets 3 times in a row. In fact, it is a bit discretionary. Imagine it like this, you already made 3 R on the first week, then on the second was 4 R, the next week you dropped down to 1 R. Based on the rule, you may not increase your R value, but if you have followed your plan consistently and faultlessly, then don't be hampered by that 1 R. You can promote yourself. Again, the objection is to get the skill. If you missed your number by a little bit, then it is okay as long as you can accountably say that you are consistent and you can prove that. Go for it, increase your R. Or you can wait, do it for 1 more week, to see whether you get that consistency or not. Because what you don't want to do is to progress so quickly then you become reckless and give all your profits back. For more in-depth understanding, let's get down to the example with numbers. A trader called John starts his new trading R plan with $3,000. In his first week, he made the following trades. Trade 1, got 3 R win. Trade 2, got 3 R win. Trade 3, got 1 R loss. Trade 4, got 1 R loss. Total R for the week, 4 R. New account size, $3,200. Then in the second week of trading he made. Trade 1, got 1 R loss. Trade 2, got 3 R win. Trade 3, got 1 R loss. Trade 4, got 1 R loss. Total R for the week, 0 R. New account size, $3,200. On the third week, here's his result. Trade 1, got 3 R win. Trade 2, got 1 R loss. Trade 3, got 2 R win. Trade 4, got 5 R win. Total R for the week, 9 R. New account size, $3,650. Based on this information, is John ready to increase his R? If you strictly follow my rules, then the answer is no. Because on the second week, he did not reach his 3-hour target. But, John can look back to all those trades taken for the 3 weeks. If he can prove that he already be consistent, he always follows his strategy faultlessly, and not being reckless, then he can make decision to promote himself. And he can also just say, hey, let's give it one more week just to show that I'm not reckless before I rise my R. Now, assume that John did take the promotion to $75 R value, then let's see the number 3 rule. It says your account size should meet the minimum requirement with the new R level. In order to follow our maximum R size rule, the amount of your risk unit must be no more than 2% of your trading account. If your new R value is $75, then you need $3,750 account size to not break this fundamental rule. So, Rule 3 does not apply, then John is not eligible yet to increase his R in his 3rd week. Back to his $50 R size, here's his result in the 4th week. Trade 1, got 1 R loss. Trade 2, got 3 R win. Trade 3, got 1 R loss. Trade 4, got 2 R win. Total R for the week, 3 R. New account size, $3,800. The question is John ready to increase his R? No, because John's reached his target R results not in 3 times consecutively. But, if you look at John's result, he had 4 R, 0 R, 9 R, 3 R. Again, if John can show that he already be consistent with his trading, then what you might say if you are John's coach? You might more confidently let John to progress further to the next R level, right? Checking at number 3 rule, in order to play in $75 R zone, your account must at least $3,750. Now John's account is $3,800. Then, is it okay to proceed to the next level? Yes, at this point John can increase his R to $70. But for the sake of the example, let's say John didn't take the promotion again, because he did not follow rule number 2. So, he's still on the $50 R size. Now on his 5th week, here's the result. Trade 1, got 5 R win. Trade 2, got 1 R loss. Trade 3, got 1 R loss. Total R for the week, 3 R. New account size, $3,950. Now is John eligible to increase his R? Let's see the rules again. Rule number 1, everyone starts at a $50 R value. Check. Rule number 2, the R level can be increased after successfully reached your R target profits, 3 R target, for 3 consecutive weeks. Check. Rule number 3, your account size should meet minimum requirements of your new R size. More than $3,750 account size to play in $75 R level zone, so check. Rule number 4, whenever you have stopped on maximum week loss for 2 times in a row, lower your R size to the previous level. Check. Now John is fully eligible to get his promotion. Then, his new R unit is $75. Next, in the 6th week through 8th week, John always hit or go beyond his R profit target per week. Then is John ready to get his next promotion? Absolutely yes. So, what's his next R unit? It will be $100. Now you can see that his account size is growing in controlled manner with knowing how much you willing to risk on every trade and in every level. Quick story before the trader journey chapter ends. The big player on the Wall Street like banks, mutual funds, hedge funds, they have proprietary traders. They hire handy MBA school graduates to come and trade the money for those institutions. As the traders trade well in the company, they will be assigned with more money to trade with, so they can make money for the company and the client. However, they follow a progression plan obviously a little different from this trading journey plan. Of course, the institution made their own version, but the bottom line is they follow a trading journey plan too. The reason they do that is because these companies does not want to hire somebody right out of the MBA program, then hey, you can risk that X amount of money, manage it as you wish. Absolutely no, no matter how smart he is, or how great his score, the companies won't allow this happen. Instead, they are going to say, here is your trading plan, here is how much money you must allocate to a trade, here is your progression table. The traders need to prove to the company that they can go through this level. When the trader can prove that they are consistent, not reckless, and get the skill, then they will be promoting the traders to manage more money, which is allow the traders to make more money to the clients, the company, as well to themselves. So, the professional is doing it the same way, using trading journey. If the big players are training their traders this way, wouldn't it make sense to train yourself to do it the same way? Now, here's the thing, when they did not follow the plan and they become reckless, the company just kicked them out. The bank just gonna say, hey listen, your R value per trade was $1,000 and you asked $10,000 on that trade? Go on, don't come here again. There are lines of people waiting to replace you in. So, always trade in your best interest, don't trade for your ego to prove that you are right. You are just somebody, market doesn't know who you are and market doesn't want to know who you are. Market just doesn't care. But the good is the market just gives the same unlimited opportunity for you, for me, for the big players. The only difference between people that consistently harvest profit from the market and everybody else is how they think and set their trade, how they apply the risk management, how to get the skill and to be consistent. Here's little homework for you, so that you can apply your new knowledge right away so it won't give evaporate. And the homework is start to make your own trading journey plan. You can start with $50 or size like I explained either on the real cash or virtual money, then start to get that consistent mental muscle pumped up. Quick explanation about virtual money. If you are using virtual money, many traders have problem when they moving from virtual to the real one. Sometimes they really do exceptionally well on the demo account, then after he starts using his real account, the results just may. How's this happen? Because principally, the way you trade with virtual fake money is not the same with the way you trade with real money. With real money, the emotions grow larger. And one common mistake that traders do is they open a demo account with big money like 100 grand where they only have 5 grand to get into this business. Yep, back to the consistency. You can't expect to be consistent trading virtual with 100 grand and go with live 5 grand. Man, that just doesn't make sense. If you have 5 grand to start, then open demo account with 5 grand balance, so you can move that consistency from your demo to the real account. That's it. I think we already cover so much information about how to master your risk management and trading. In fact, I don't know what extent that I should discuss about this topic, lol. I hope you get the importance of risk management and do the actionable steps I give, so that you can improve your trading system in consistent and not reckless manner. In the next chapter, we are going to discuss about the other thing that is essential for you to become professional trader for life, which is trade management mastery. You will learn about traders' fears, the right psychology you must remember every time you enter a trade, and simple, effective strategies which I personally use to get consistent profit and make the best return out of my trade. But, before you jump to the next chapter, I hope you do your homework. Because no matter how vast your knowledge about trading, if you don't take any action about it, it will be useless and become obsolete. So, do your homework. Identify whether you already use our trading system or not. Identify whether you already have your trading journey plan or not. If you haven't, then do the adjustment. If you now know the right way to preserve capital which professional traders use, why not do it now? Wow! We have cleared the first section of the video series. Quick checkup to you, have you already do your first homework? If you haven't, you might want to do it first. Complete all the homeworks before we advance to trade management mastery. Alright, I know you can't hold your excitement to get the next lesson. So, I will give you some about what we will talk about in the next few minutes. And no, we will talk about trade management. Just like the previous chapter, I will give you mindset thing first to build the right foundation in your mind, so that you will get along the next lessons very easily. Okay then, let's get to the preview of the second lesson. In trading, there are common major fears that traders faced. Fear of loss, fear of missing out, fear of leaving money on the table. And that is what trade management complete the missing piece of the puzzle in the world of trading. What you really want to do is to create a simple and easy to follow trade management plan, so that you can neutralize these fears out of your mind. When you do that, you won't take decision based on your last trade. So it is in line with our primary goal, which is to be consistent. Also remember, in order to be professional trader, you must become master of risk and trade management. Not to be missed in trading. First, spot your strategy. First, you want to identify your strategy based on the chart. It consists of reading the patterns, indicators, candlesticks, fundamental, news event, trading session, etc. So, you must be clear to rule out the chart which trade you want to enter and which one you don't want to take. Second, calculate your risk-reward ratio. Remember, you don't want to make 1-to-1 risk-reward ratio. It requires high winning percentage of your strategy, and taking more trades to make any amount of significance money. What you want is to take at least 2-3 risk-reward ratio trade. Third, consistent trade management. You will see later how you really need consistent trade management plan, so that you won't trade based on your last trade and emotions which can neutralize the randomness of the market. Fourth, keep collected. Emotional maturity and ironclad psychology are essential for your success in trading. If you don't have these, you will trade randomly in random market. You already know what the result is. It doesn't make sense for you to get consistent profit by trade randomly in random market. How to manage your trade well. Trade management is undoubtedly important because there is always emotion involved when you trade. And when it gets the best out of you, managing trade can be dangerous. Many traders just like where I should set my target. Is it the right time to take profit? Should I continue it even further? What happen if I continue this trade? It will drive you crazy unless you have a simple plan that you can follow. Do you have a specific trade management once you enter a trade? If yes, then you do, then great. So the next step is you must consistently follow it. Many traders out there still don't have their own trade management plan. How do I know that? Many traders in Facebook group, Telegram group still seeking answer like, "Hey, I'm on this trade. Where do you think I should place my target?" Or ask, "Hey, do you think stock ABC can go further? I want to change my target whenever possible." So if you asking somebody and trying to change your trade once you enter it, then you don't have trade management plan. Because you should know in the first place, where do you place your target and know when to sell. What interesting about trade management is there are many ways for you to manage your trade effectively. As a trader, you are a unique individual. There are no two traders that are the same. So, trading is very personal. What might work for you, might not work for me, might not work for somebody else. So, even a trader copies a successful trader trade plan, there is always difference, even small difference in trade management between one trader to another trader. That is why you should pick one plan that really fits with your style. Why only one? So that you know at a time, what works for you and what doesn't. How do we test it? Just stick to the plan you pick for a number of samples. That is how casino owners does. If they have 5% strategy on their game, then they will know for every 100 games played, they earn 5%. So, they just don't get upset when the gamblers win or when the gamblers lose, because they know, from statistical standpoint, they will make money with this strategy. After that, journalize every trade you take. It sounds boring, but how do you know if your strategy works if you don't take notes about it? Then after a handful of trades like 10-20 trades, it is time for you to assess whether you should make adjustments to your strategy or not. If yes, then do it. Improve it, adjust your strategy based on your result, build it to be more and more fit to your style. And the last is keep doing it, over and over again. Well, to make it more easy for you to refer back to this later, I summarize simple steps for you on how to master your trade management. Pick one plan that suits your style. Test that plan in 10-20 trades. Journal every trades you take. After that 10-20 trades, review and see the plan whether it works or not. Make adjustments to your plan if needed. So, that's it. How do you like that? If you really get values from this almost 2-hour video lesson full of content, then, please support me and this channel by subscribing, like, comment, and share the video. Of course, the trade management lesson is not over yet. In the next future video, I will give you my plan that I use over time in my trades. I am super excited to share it with you and hear your success story. So, stay tuned, and once again, don't forget click the notification bell to get you informed when the trade management lesson video being ready for you to watch. Until then, Jonathan Peter from Profit Crafts, signing off. Have a marvelous profit.
Hey guys, we already covered a lot, but I still have one more video for you in the next future. If you follow along, there are 2 things that you need to become a successful trader in the world, okay? So the first one, we already covered it, which is risk management mastery. And the next video, which I'm about to upload, is the trade management mastery. So, if you want to stick around, and if you think this is useful, please click subscribe, share it, like, and comment this video. So it makes me very happy and get really excited to upload the next video, okay? So thank you for watching. Have a good day.